Welcome back to our video series about how to buy your first car. After you've picked out your car, your next step will be determining financing and insurance. This is the last opportunity dealers use to make more money off their sale to you. Typically, dealerships do not do their own financing. Finance and insurance people, also known as F&I, take the estimated price of the car, the actual value of the car, and your credit history to shop the deal to a number of different lenders. These may include local banks and credit unions, as well as national lenders and manufacturer finance departments. These vendors each quote an interest rate and relevant fee information to the salesperson or sales manager. Car dealers usually have long-standing business relationships with these lenders, which may include incentives for selling a loan from a specific lender. In addition, dealers may have the option of marking up the interest rate to earn additional incentives. The lenders are competing for the dealer's business, not necessarily for yours. Make no mistake, financing is profitable for dealerships in many ways. Unless you come in armed with a pre-approval, you're almost always better off if you make financing the last part of your transaction with the dealership. This doesn't mean, though, that you don't want to think about financing until that point. The dealer is trying to sell your business to a lending organization while making as much profit as possible on the transaction. Come talk with us at the credit union before you reach that point. We can help you identify price ranges and terms that are best suited to your budget while also getting you pre-approved. It will shorten the process for you, give you buying leverage, and minimize your susceptibility to aggressive sales tactics. Is 0% financing worth it? If you're shopping for a car because you've seen an advertisement for 0% financing, you're not alone. If it were honestly a losing proposition for the manufacturer, they likely wouldn't keep doing it. How then could they possibly make money on the financing? The answer is twofold: volume and selectivity. The volume part of the money-making strategy is simple. 0% financing gets people on the lot and encourages them to think about buying a specific brand of car. The manufacturer and the dealer both make some money on each car sold, so the 0% financing trades some profit per car in the hopes that they'll make up for it in the number of cars sold. Selectivity is the other side of volume. Not everyone who comes to a 0% financing event will qualify for that rate. These loans are usually short-term, and if your history with credit is anything less than perfect, don't expect to qualify for 0%. Choosing 0% financing will often prevent you from taking advantage of other discount options, like manufacturer rebates and other discounts. This last hiccup can mean 0% financing is actually more expensive than a loan that's obtained through a private lender like the credit union. To see this effect, let's take a look at two options. Option 1. At 0% financing gives you a monthly payment of $555. Assuming no other fees or problems, you'll pay $20,000 over the life of the loan. Option 2 is a 4% interest rate on a 5-year loan from the credit union plus a $2,000 manufacturer's rebate. Your monthly payment will be $331.47, a much more reasonable amount. Over the life of the loan, you'll pay a total of $19,890. That means you will save $110 and have a lower car payment too. Arranging outside funding before you go to the dealership can be a tremendous negotiating advantage. By continually postponing questions of financing, you can let the dealer think there's still money to be made. This position might lead them to give you more on your trade-in, lower the price of the car, or offer you more options. The loan you get to pay for your car may be the biggest financial decision you make besides your home. You owe it to yourself to do your research and treat this decision with diligence. Now let's talk insurance. Although most people are well aware of how their driving record affects their insurance costs, many don't realize just how much their choice of car affects the rates. The age of your car has a lot to do with your insurance premiums. That is because the older your car gets, the more value it loses. The make of your car has a big impact on rates too. High-end luxury cars usually cost more to insure because the cost of parts, repairs, or even replacement in the event of a total loss can be very expensive for the insurance company. The model also has an effect on insurance rates. Two different models from the same manufacturer can have different rates. In fact, even the difference between two cars with different trim levels and options can make a difference. The risk of theft also impacts insurance rates. Generally, due to higher rates of vandalism, theft, and crashes, urban drivers pay more for car insurance than do those in small towns or rural areas. Insurance companies use statistics to determine how high the odds are that your car will be stolen and set rates accordingly. Other factors you may not realize affect insurance too. People who use their car for business and long-distance commuting normally pay more than those who drive less. Crash rates are higher for all drivers under age 25, especially single males. Insurance prices in most states reflect these differences. However, the silver lining is some car insurers provide discounts to student drivers who maintain good grades. Also, many insurance companies use credit history to help determine the cost of car insurance. So before you head down to the dealership, do some research. Does the vehicle that has caught your eye have a high cost for repairs or parts? Is this specific model often stolen? Knowing the answers to a few simple questions can go a long way in keeping your rates low. Discuss your plans with a representative at the credit union, including the type of vehicle you're thinking of buying. Figure out what kind of rates they can offer. By doing your research ahead of time and knowing what financing options are available, you can let the dealer think there's still money to be made in the financing, which may strengthen your negotiating position on other parts of the transaction, like the price of the car or the value of the trade-in. The last decision. You've finally done it. You've gone through the test drives, the sales talk, the self-doubt, and the sleepless nights, plus the mountains of paperwork. The car of your dreams is yours. But what if something terrible happens to it? You don't want to be the one to pay for that, do you? You don't. So you fork over another $1,000 or more for an extended warranty. What is an extended warranty? You pay an insurance agency for a policy and they'll cover the cost of repairs after your manufacturer's warranty expires. In reality, more than 55% of participants in a recent consumer report said that they've never used the extended warranty they had bought. There are a few legitimate reasons to invest in an extended warranty. For one, if you're buying a used car, you might want to use the money you save on the actual car to pay for some extra repair coverage. Used cars are twice as likely to malfunction as new ones, especially since you don't know how well the past owner treated them. But almost all brand new cars come with 3 years of manufacturer's warranty. Don't pay for something you're already getting. Another popular add-on is GAP, or Guaranteed Asset Protection Insurance. GAP covers the difference between the total amount of the loan and the value of the car. It's protection against the worst case scenario, that your car is totaled and you owe more than it is worth. Dealerships maintain institutional agreements with the insurance agencies, expecting you to purchase it without much thought. It's one of the last chances they have to seek profit on the sale, and they rely on you not to notice. Be prepared to say no to all the extras you may be offered at the dealership. While you might not think so at first, the credit union offers these types of coverages and has a strong track record of protecting members' purchases. Members have saved thousands of dollars on their claims and helped keep debt scenarios from turning into nightmares. You can always contact the dealership at a later date to negotiate prices with them if you choose. As you start your search, be sure to use our auto loan payment calculator to see how your down payment, trade-in, and auto loan interest rates and terms affect the amount of car you can afford. Once you arrive at final numbers with the dealer, bring a signed document with the price of the car to the credit union and let us get you financed.